Hey everybody, so I'm going to be making this video today to talk about Chinese stocks and how I think they could be playing out in 2026. I'm generally very bullish on Chinese companies in general just because of I think they're very undervalued when compared to the global markets. You know, um, but I'm more bullish than ever 2026, 2027, and unfortunately as late as 2028. But we us China bulls have been waiting for such a long time that I think we've sort of bottomed already, hopefully, unless some kind of black swan event occurs. But if a black swan event occurs, then I would probably expect a quick recovery similar to 2020. Not because of anything in particular, but there's just numerous reasons why it would have to happen, where global liquidity would rise. So I don't really know where to start. I was basically looking at a bunch of different things here, and I even have more tabs open. And yeah, I'll be going over that. I'll be taking my time in this video mainly because there's a lot to talk about, but I'm gonna try to keep it as to why I'm bullish on China. So before, being bullish on China was hard. Like everyone who's a China bull knows that China owns the means of production. China is has the economic advantage over the United States. And financialization and globalization, these are things that are just happening as countries emerge. Okay, so like we have third, first, and second world countries, and as third and second move up, yes, countries have to financialize more because there's a limited amount of capacity in which the world can take in at one time. Things like the UN Charter, other international frameworks, like they do matter. WEF, these things matter. You may personally not agree with it, but it really doesn't matter how we feel as individuals. I think we should just play the game how it is rather than let our own feelings too much impact our decisions. I mean, we all have our own biases, right? I'm a China bull. Okay, so yeah, with all that being said, none of this is financial advice. Please do your own research. Everything I've said, anything I've ever said, is a complete joke at best. I'm an idiot. I don't even know what I'm talking about. And yeah, I'm just sharing my humble opinion. And my opinions are constantly changing because, well, there's so much data out there that every time we come across something new, our opinions change. So I am very bullish on China. We are in the United States. We are currently in a K-shaped economy, right, where the real economy isn't doing too well. The cost of buying into assets in the United States is becoming increasingly expensive. Like if you wanted to buy a share of the S&P 500 versus wages or buy a home, these things are going up drastically to the point that it's not really sustainable. We have to consider things like demographics in the United States, that like, yes, when elderly demographics die off, it does free up resources, especially if like older demographics tend to be the ones who own most of the paper assets, own like real estate, stocks, bonds. And yes, if they pass away and we do have taxation policies, then yes, a lot of resources are freed up and the pyramid scheme goes on, right? So that's one thing. And also the amount of how expensive social services are as well. um you know I've noticed that in the past 20 years the cost of living has gone up so much. I mean, I'm not 20 years old, but I've noticed that in the past 20 years, just as a time frame I can give, cost of living has gone up so much. But there were times when it was okay and sometimes when it was really bad. But mainly this started because of the tariffs on China. And I don't know how a president or a government can fool their constituents along with the masses that tariffs were somehow not going to raise the cost of living, especially if one of our biggest trading partners. Especially because I think, in a lot of ways, personally, China was one of the main reasons why we handled the 2008 financial crisis so well, because they could export a lot of deflation. They were buying a lot of our debt for years, and they're giving us affordable goods. And so these affordable goods, it's not just your toys and your shoes and things like that. It's all those things plus your technologies and components and all the pieces for your cars, all the pieces for your factories. So everything, like from our farms, our businesses, like we need China. So, you know, profit margins, if they want to keep increasing, you need to do a lot of financial engineering. Like you can increase your profit margins by maybe, lowering wages, for example, or keeping wages stagnant while printing more money and raising the cost of these goods and services that we to offset the amount of tariffs or taxes that we're placing onto the the tax, kind of like a VAT, like kind of like a VAT, but not really at the same time, right? It's like the China VAT, but not really. So yeah, but yeah. That being said, I think that we're in a position that the United States is most likely going to be on better terms with China. I've been saying this for years, but I think now it's going to be more apparent than ever. And there's a lot of reasons why I can think that. I'll be going over some of the financial indicators I'm looking at that make me feel this way, but I'm going to give some personal observations I've noticed throughout the past few years. So, when we saw over time, we saw the anti-China rhetoric go down tremendously, and the positive pro-China rhetoric go up a lot. And you know, I think personally that people can change their opinions about a country really fast. I mean, the sentiment about how we feel about China today is how we felt about Japan in the 70s when they're emerging economically. So our perceptions of a country can change vastly, can change really rapidly if our country wants us to. And it can be done in creative ways, but I don't want to go too much into that. So like let's just say that perception of the positive view of China was like 30%. I don't know, like 5 years ago. Well, it's much better since back then, right? And it's gotten better. But I've noticed in the past year, it's gotten much better. And so at the same time, I did notice the Hang Seng recovered a lot. I think their lows were around 16,000, and since then it's recovered. Could have been. There was a lot of support from both the government side and the private side as well. So I think there's a lot of things that are just kind of lining up, and if I could name like every single thing, the list would be way too long. But I'm noticing that, yeah, globally and even domestically, like people in America are just accepting the fact that Asia is not bad as they used to believe, and that China is a good thing. So if you ask me if I thought Trump was an anti-globalist, I would say no. I think he's very much globalist. I think that he's very much an actor. Like it wouldn't have mattered if it was Trump or not who was president, but everything he's done, when you follow the capital flows, has shown to me that he has been very good for China. Like whether it be from the tariff and trade wars, which China won in my opinion, but there's really no such thing as winning. Like you want certain types of trade dynamics to change as third world countries move up, and second world countries move up as well, and first world countries are having to adapt to absorb second world countries moving into first. So changes need to be made, agreements need to be made, real structural economics need to change as well, and society needs to change as well to handle that. So like one example would be is that you can't have Japan, China, South Korea, Australia, Canada, Mexico. You can't have all these. You can't have everyone just produce like high value vehicles, right? Because having competition like that, it's good to some extent, but at the same time, while there is a never-ending demand side, the amount of capacity that this world can handle at once, like it's not very sustainable. So like it's very environmentally intensive. And so you may not agree with climate change, but I kind of do, mainly because it kind of makes sense. Even if we don't agree with it, it doesn't matter. This is what countries follow no matter what. But yeah, so for example, you can't reform the United States from going from internal combustion engine and oil to green and climate change friendly overnight. It takes time. So a lot of these things take decades, years and decades. So Trump became president in 2016, and it's already been 10 years. So since then, and probably before that, the United States, China, and a bunch of other countries understood that the world has to develop in a certain way. Post World War II Bretton Woods, if we want global peace under a world where nuclear wars can be the extreme, and that means 5 billion people die, or we can have a peaceful coexistence or relatively peaceful coexistence, everyone needs to win. So for example, when you look at the United States invading Venezuela oil production had went down tremendously since Chavez, I think. But if you can boost oil production, if you anticipate increased global liquidity, and you think your country's gonna have more productivity, then perhaps the United States can have more supply chains that benefit from the global production growing. So I predict a few things, like global production growing, global liquidity increasing, borrowing costs becoming much cheaper, but at the same time capital flows, which is the most important part, capital flows moving out from the United States and into different countries. So I have here the PE ratios by countries. And so if you look at countries like Brazil, India is kind of high, China more importantly, China is a powerhouse of a country. We look at them as a country that owns the means of production. Like, I think everyone's already accepted the fact that China just dominates in like every sphere. And when you have more STEM graduates on average, your population is around 1.3 or 1.4 billion, and you're in a location that you can build very effective supply chains along with countries that are developing, and you have a big consumer market here and here and here and here, north, south, and east of you. Like, you are naturally just going to be an economic powerhouse. But one of the main things that I think a lot of us China bulls have been very concerned about is that we know that Chinese equities and Chinese assets are generally undervalued, but like we don't really understand, like, why aren't we seeing the return on investments, and why have Chinese equities performed very poorly, let's see, for example, when we look at like NIO versus Nvidia versus Palantir, I mean, look at the performance of NIO and Palantir, right? They all generally kind of follow the same trajectory, but around Q4 or Q3 of 2023, things had just changed dramatically, right? The AI bubble had occurred around here. So, at this time I had puts on Meta and I cashed out, and I did pretty well. But, I was anticipating that China was going to do much better than where they are today. But if we exit out of Nvidia and we look more at Palantir, right? Yeah, so around May, June, July, so around here, September-ish, August, so Q3, Q4 of 2023, yeah, a lot of companies like Palantir just took off, right? And I think the reason why is that the AI bubble started to form. And so when you have the AI bubble forming, there's a lot of reasons as to why that could have happened, but mainly it could have been like, well, you need to have, basically the Fed is raising rates at that time, maybe a lot of high margin, somewhat profitable companies under these conditions, maybe a lot of like the Magnificent Seven, for example, does really well. Nvidia does really well, for example, because of things like their really, really high forward guidance, or maybe things like their earnings and things like that. Or basically they just get priced really, really high. So, if someone said, like, is Palantir, Nvidia in an AI bubble, would I agree? Yeah, but that's the story, right? The story was like there's an AI bubble and their guidance under these economic conditions, under these geopolitical conditions, meant that they deserve these high valuations and whatever else you want to hear. Like I've heard it all. Like I've heard all the reasons why. Okay, and so yeah, it's a little frustrating to see this, and we need to understand why that happened, right? So I opened up a lot of things here um, that I will eventually get back to. I kind of forgot kind of forgot what I even looked at half the time. So I'm gonna go one by one. So when we look at GDP is not always a good, accurate way to show the value or how deep the financial markets can really be, or the capacity in which the financial markets can be. Um, yeah, so I mean, even the GDP growth, like 4.8, and the per GDP per capita, and the GDP is like, is this really an accurate representation when you have 1.4 billion people? I mean, yeah, a little bit. I mean, I could see how, if you consider that not everyone in China, for example, is doing these high value, well, not they're all valuable, but like high gross domestic productive types of output, right? Because like there's a lot of people who live in rural areas, and there's a lot of people who live in tier 1, tier 2, and tier 3, and I think tier 4 cities and rural areas where not all of them have the same amount of GDP. But when you measure value, when you measure economic strength, when it comes to geopolitical negotiations or trade dynamics, like when countries like the United States and China really have to measure up their economic strength, GDP is not a very accurate metric for measuring economic strength and like social strength and like country strength. Like I would argue that China is just is a much stronger country in terms of military, economic capabilities, social structure, geography as well, and even with their allies. I mean, you can argue that Japan, like Japan, for example, is on the United States side, but thinking Japan would ever fight China is a ridiculous thing, because if the United States ever want to use Japan as a proxy war to fight China or Taiwan, I'm pretty sure Taiwan, Japan, and any other proxy, South Korea, that that the United States wants to use to fight their Western imperialist war, would just join China's side and fight the United States. Because why would you die for a country that doesn't even care about you, right? So like, let's just say you're Japan or you're Japanese, and you're doing most of your trade of China and all these other countries here. Are you really gonna fight China because a United States American told you to? No, you're gonna mind your own business and just do trade and just try to make the best of things. And if the United States forces you to fight a country that you don't really want to fight, you're gonna turn against the United States instead, and join China. So a lot of these things is political theater, in my opinion. Like, I know there's a lot of tension with Japan and China right now, but I don't really think it's that big of a deal. Same thing with like Venezuela. Like, yeah, it's a big deal, but like, it might not change the grand scheme of things. And again, like, if as I've said earlier, yeah, United States wants to build up its supply chains if they're going to have more Chinese foreign direct investment come in and build their Chinese factories, like NIO, for example, right? So China last year, 2025, was floating the idea of a $1 trillion trade deal with the United States, like a trade package where they would be sending things like foreign direct investments. So, I'm pretty sure Trump wants to do a few things, right? He wants, first of all, as a country, not even about Trump, but you want to get rid of this AI bubble. It's not really good to have your financial markets and all of your wealth be transferred into the AI bubble, which I don't even really know the accurate breakdown of ownership, but it's not like it's entirely owned by the United States. And you don't want you don't want to rely too much on financialization in Bitcoin and cryptocurrencies, and the AI bubble, because these things can make your economy much more fragile. Like, if someone wanted to attack you through the financial systems, they can sell off bonds, they can sell off assets, they can sell off stocks, they can sell off cryptocurrencies, and just create more and more volatility and economic and social instability through those means. Another thing they can do is that a good thing that the United States and many countries can do, though, when it comes to Bitcoin or the AI bubbles or these types of asset bubbles, is that they can control it, right? They can use firms and they can use the government policies and interventions to control capital. So they can limit capital flows or increase capital flows. They can, like, for example, if the United States eventually needs more laborers, they can reduce the cost of Bitcoin, or they can reduce the value of Bitcoin or the AI bubble, and that would definitely free up the amount of labor supply, right? So yeah, when it comes to GDP, it's not very accurate measurement. It's clear that China, when you have 1.4 billion people within the geography, is it's just in a much stronger position to fight. Okay, and there's no real fighting, I would say. It's just there are political day-to-day news that needs to happen for whatever reason. Profiteers trying to profit off the news, centralization. But what would you expect as countries move from a second to first world development? Like, countries in the first world need to adapt to adding 1.4 billion out of 8 to 9 billion people in this world. Like, they need to change a lot of their structures economically and socially to handle 1.4 billion joining their economy at a higher level. So when China joins like the WTO, or China opens up its markets under Deng Xiaoping, like, it's really when they start producing like lower value goods, like textiles or minerals or resources, like lower value ladder stuff. Like, it's easier to introduce 1.1 billion plus people because they're not, well, a lot of people get harmed through all that, but it's just much easier. But when you start competing in like first world country exports and imports markets, that then yeah, it starts affecting them. So that, yeah, things have to change structurally. More rent seeking needs to be had. So in the long run, you do want the United States to financialize more, and you want China to financialize more, along with other countries that are in the first world. But you also want to increase global liquidity so that third and second world countries can move up as well. And I think that we're going to be seeing a moment of time like that. So when I look at the Trump presidency now, it just seems like it was sort of like a lead up to these types of things. Okay. So maybe he wasn't even supposed to win the 2020 elections because it would have been too soon. Honestly, I think it would have been too soon. Like, if under Trump, you wanted certain things like lower interest rates, and you wanted to bring Chinese foreign direct investments like NIO or BYD factories into your country, then you would need to make sure that the stars align. Like, you need the electric vehicle price war to end. You don't want Chinese companies that aren't really that good coming into your countries, and just building out joint ventures with your American companies. You want to limit the amount that come over, and you only want the best of the best, where they're going to have government support from both governments, along with stable financial markets, stable financials. Because what if you brought like what if there was like hundreds of electric vehicle companies in China, and you got a bunch of lower quality electric vehicle companies that maybe IPO'd on the NASDAQ or the New York Stock Exchange, and they wanted to build plants in the United States. So they raised capital and they formed joint ventures with like other SPACs or with like other American automakers. Like, yeah, you can put $2 billion of your investments down to build a factory in the United States using the Chinese company's capital, but in the end of the day, you're using United States American capital, using late American labor for the most part. You're using American resources. And if your company fails, or if it does poorly in China, but your United States branch does okay, I mean, if the company goes bankrupt, then both countries are going to be negatively impacted. So why would the United States do that, right? So when you have companies like XPeng or BYD or NIO or Li Auto, which seem to be doing okay, or even Xiaomi, right? When they seem to be doing okay, they've gone through the hectic electric vehicle price war. Then, if you're looking to merge or do acquisitions, or if you're looking for joint ventures, if you're an American company or American government, you're gonna think, well, it seems like they've weeded a lot of the junk ones out, so it's a good time to bring them over. So the electric vehicle price war was necessary, in my opinion, if as an American, for example, because if I were like a governor, for example, or if I was the president, I only want the best of the best that I know for sure is going to have strong economic moats and strong balance sheets. And if you're a president, you don't have the time to look at the balance sheet of each individual company and financial statements, and you don't have the time to look at things in and out. But when you have them go through like electric vehicle price war, and the survivors win, then you've kind of sorted out a lot of the work, and you don't have a bunch of like junk companies coming over and just opening up shop. So I think that is one indicator in which, like, if you see the electric vehicle war ending, it's not about price, it's not about profit margins rising after the war ends or anything like that. I think it's more about the possibilities of Western markets and other countries looking at these companies as potential joint venture partners, or like more stable to introduce into their markets. I mean, if you're like Australia or New Zealand too, even if you wanted to build like factories or form joint ventures or bring their vehicles over, you don't want to do it with companies like Fisker, for example, where they're not doing so well. You want to do it with companies that have good backing, who have a lot of who are profitable, who are doing well in their own domestic markets, and who are time proven as well. And that's the companies you want to bring over. So that's one indicator of which, like, you could see in return the company also do better. So when a Chinese company like NIO or BYD build, or even Tesla, builds their electric vehicles in China, the profit margins are going to be much higher in China than they are in the United States, because lower labor costs, less regulations, the supply chains are just way more efficient here as well. But that's okay, because these countries just want to access the Western markets where their profit margins can increase heavily. So in the end, even if like their profit margins from a vehicle produced in China is substantially higher than one in the United States, they would still benefit from the higher consumer demand and purchasing power in the United States. And at the same time as well, even if each vehicle in the United States for a NIO manufactured vehicle isn't as high in terms of profit margins, I mean, they probably will be decent, but like the real value, like, if rather than have it manufactured in the United States, if you were to manufacture 100 NIOs in America, in Missouri for example, but you manufactured like 500,000 in China, you could still share the profits, right? And the net profit margins for shareholders some people might look at factories, right, and be like, well, the capacity was X amount and the profit margin per vehicle after operation costs were this amount. But the stock price might not really care about that, because I don't really see too much people really care about Tesla vehicles manufactured in like Nevada or Texas not being as high profit margin as one in China. Like, no one really cares. They just care about the net, right? So at the end result. So yeah, I think that's what's going to matter much more when and at that point too, governments and shareholders and retail investors and firms will see these companies in America or even Western countries like Australia or like New Zealand and think, well, like, I see the product, the sentiment's up, I own the vehicles, and our government or our institutions and firms or our people, society, would benefit greatly if the stock goes up, because maybe they own a share in it, or maybe they own like a stake in the company as well now. So yeah, you have mutual interest from the financial side along with the actual value being produced in the real economy. So yeah, by then you could probably see the stock price appreciate tremendously. So when we look at real residential property prices for China, now it looks like it's on a downward trend, and it is, right? But at the same time, Xi Jinping said that homes are not for speculation, they're for living in. And so at one point in time, you do want a lot of speculation because it promotes more home building, which you need to do. So when people were complaining about ghost cities, for example, in China, that was one of the big scares. How there's excess capacity of these homes. It's good because as the country develops, you want to bring people from tier 4, 3, 2, and rural areas into tier 1 and tier 2s. So by building more homes in like tier 3 and tier 4, for example, I mean, they're doing this in Vietnam, for what I saw. Yeah, a lot of it's going to be government subsidized. A lot of it's going to be capital. Like, there's just going to be a lot of resources placed into this. Yes, it's going to help GDP a lot. But, you want these things to happen because more homes does bring down home prices. And while a lot of Chinese did use real estate value going up as for the wealth effect and as a hedge against inflation, similar to how Americans use stocks or even real estate here, in the long run, if you really want things like birth rates to rise, or if you want consumption to grow, if you want people to move away from real estate and into stocks, for example, and Chinese stocks to increase the potential of your financial markets and financial efficiency, you don't want your people investing in real estate. You want them moving money away from real estate and moving into stocks, real estate, bonds, and other things that help the real economy. Because if you have it all concentrated in real estate, it's not very productive. So it had a purpose at one point, and it still does, especially as China's developing, when you're bringing rural people into urbanization. But to what extent, I don't really know for sure, But I know countries like Vietnam, for example, their real estate is being heavily subsidized by the government, I think. And then you have a lot of people who are bullish on real estate as well. But at the same time, like, the wages are really low there, and the real estate prices are so unaffordable that it doesn't really make sense. It's like worse than the United States. So you want these prices to go down. And it's not bad either, because if you have deflation in the real estate bubble, it does allow for, in the long run, for more people to have a higher purchasing power. It can destroy the wealth effect short term, but a lot of these things can be regained over time. And even if you crash, right? So even if you're having your '08 moment or whatever they joke about, right? It doesn't have to go all the way down. It can stabilize at a certain level. But at the same time, it's not as extreme as what a lot of Western news audiences will say. When you have 1.4 billion, it's not like 1.4 billion people are losing the wealth effect. No, it's a certain amount. It's a certain demographic of people who own real estate as a means of investment. So if you can move money away from the real estate sector and move in towards stocks and bonds, and the real economy and productive ways, then you can really revitalize the economy through that. So the wealth effect, yes, it did get destroyed, but you can find it eventually has to recover. So yeah, the Japanese 30-year has risen above the China 30-year, while the China's 30-year is going down. So the United States dollar versus the United States to yuan is also going down. Last time we saw this, and I think for me personally, we want to see. I think the United States is going to be in a position where you're going to see capital move away from the AI bubble, and it's going to deflate the AI bubble. I don't think it's appropriate for the AI bubble to crash. It doesn't sound like it's very productive for the economy, because the AI bubble right now, along with the Mag 7 and the S&P and the Nasdaq, all these large indices, they act almost like a universal basic income, and they create a wealth effect as well. So you don't want to pop the AI bubble. I mean, I know Michael Burry, for example, says that the AI bubble is going to pop, but I don't think it's going to pop. I think it could deflate. And if it does pop, it does, right? I mean, I might hedge against. I might have some things set up just in case, but you don't want the government. I would assume that the government doesn't want the AI bubble to pop, mainly because the purpose of it as a vehicle, yeah, acts like a UBI, acts like a wealth effect, props up a lot of portfolios and savings and investments and 401ks and retirement funds and pensions, along with a great way of tax revenue for the government. So I don't think the government really wants it to pop. I do think it wants to deflate a little bit, or at least slow the growth. So if you increase the overall money supply and global liquidity and have it slowly deflate, or at least slow down the growth relative to the size of the overall money supply and circulation and the global liquidity, then you can have some of that slow down and have money move towards other assets like the real economy or into China. And so that's what I think is going to happen. I think that what we've seen over time is that, yes, China does have capital controls, and a lot of countries do, right? And when you're a country as complex as China, you want capital controls, in my opinion, because you don't want someone exploiting your country too much. You don't want too many opportunities for arbitrage. You don't want you want certainty, especially when other countries that are developing and very unstable are borrowing from you. And there's a lot of reasons why you want capital controls for a developing country like China. So, but despite that, I think countries like China or Vietnam, but more specifically China in this case, are actually allowing for like more cross-border flows, for example, or they're making it a little bit easier to, or giving a little bit more incentives rather than strict capital controls. Well, I mean, it's still pretty tight when you compare it to the United States, but yeah, I mean, it's getting a little bit better if you're an investor. So yeah, there's that. So I would imagine that as lower as the United States Fed lowers interest rates, the AI bubble will eventually, deflate as well. So money will go into things like U.S. Treasuries and global Treasuries, but more specifically, probably in the United States, maybe China, maybe Japan, maybe Europe as well, countries like that. So you might see like a rotation from the United States into the East instead, like Japan, Europe, China, and other areas where there can be better return on investments. And I think that at that point, when you see the AI bubble kind of deflate or pop or slow down, then the risk versus reward for United States equities or stocks or things like that become more risky because of opportunity lost, slower return on investments, potential for negative return on investments. And if you think that a Palantir, I think the PE ratio is anywhere from like 100 to 500. I don't have to look. If you don't believe in the AI bubble and you think it's a Ponzi, or if you don't believe in it because you think it's like Enron, then capital might move away from the United States and flow into places like China. So I think that we could see a position where, yeah, the yuan strengthens over time versus the dollar in response towards capital moving out from out of the United States and into China, along with like government policies and monetary policies that in the United States that doesn't really support capital inflows. But it could help the real economy, right? If home prices come down through purchases of agencies, for example, or certain things are done, along with the AI bubble deflating, it might destroy the wealth effect in some aspects, but it might help the real economy too if certain bubbles are deflated, or maybe wages rise a little bit, or the purchasing power goes up, or tariffs are reduced. So I do see a situation where the AI bubble slows down or deflates a little bit, capital moves out of the United States and into places like China. The interest rates of both the United States and China are lowered, but the United States at a much more rapid rate to attract real foreign direct investments into the real economy. Well, capital flows into Chinese bonds, Chinese equities, Chinese stocks, and I think it's mainly gonna be because Chinese companies are just generally undervalued. The PE ratios globally are much lower, so it's going to be firms looking for higher return on investments. And seeking return on investments, yes, I'm sure that a lot of firms are discouraged from investing in China, not because people don't think it's a great deal, but mainly because you can weaponize the financial system against the country if you want certain things done, or not even just weaponizing it. You want to have finances, capital flows to act as a UBI in a time where reformations are being made. So I don't look at these countries as really warring in any sense. China and the United States, I don't view it as a war. I think it's just reformations and changes are being made. So you want capital and different resources to flow in different ways. Let's see, what is this? Yeah, so China is increasing their domestic consumption, and there's always a lot of let's see. So Premier Li Chang said government will boost household consumption by strengthening loan support for services providers, enhancing interest subsidy policies for personal consumer loans, and expanding the supply of high quality services. So that's good. And yeah, I think the Chinese government has been pushing out a lot of sovereign bonds at a rate that's relatively high historically. I'd have to look into that more. Let's see, what else can we find? So let's look here more at the treasuries. The 10-year treasury, let's see, what was I looking at earlier today? I guess someone needs to buy me a trading economics account, because I would love to have more data on this. It'd make my life way easier too. So we see here that yields have slowly been going down, but it's back up to 4. We'll see how that goes over time. Let's see, Japan. I think this is Japanese interest rates. Yep, Japanese interest rates have been rising. So the yen carry trade is slowly unwinding. So when the Japanese carry trade does unwind, it's not like it's going to happen overnight. It's just like in sessions, right? As other positions become more attractive, then investors and firms will take out, and they won't try to do arbitrage on on Japan anymore. So let's see, yield. Okay, so Japan yields are rising. Looking at, why did I have all these open? Okay, 3.2. I know I had a reason earlier. I think I was too focused on something else. Okay, so yeah, when we look at the China 10-year bond yield, the bond yields are, it seems like it's kind of bottomed out here. And you know what I thought was really interesting? The bond yield, the 10-year bond yield, kind of mimicked a lot of what NIO and some of these Chinese stocks have done. So when yields rised, it was a good indicator, sort of, when Chinese stocks had sort of found a bottom. And since then, like, I noticed a lot of Hong Kong stocks and a lot of popularly traded Chinese stocks, they've kind of followed the China 10-year the China 10-year year bond yield. So when you see these big spikes, like it was give or take around the same times, like Chinese stocks would, like NIO would soar and then they would drop, and then they would soar and then they would drop. So based on this, if yields keep rising, then we could see the stock recover as well. So let's see, 2020. Yeah, hopefully we see more capital inflows, and more positive investor sentiment as yields rise. I mean, again, as I think if we do see treasuries, if we see the yield on the treasury drop, which is kind of good for the United States because it's very expensive to pay off interest on all of our debt. If we do see the 10-year drop, then maybe we'll see something of a China carry trade, like a yuan carry trade, not to the same extent because of capital flows and capital controls, but with I would wonder that if we do see a yuan carry trade, like the Japan yen carry trade, if because Japanese if because Chinese companies are so undervalued right now relative to Japan. Like China's PE ratio is around 10. Okay, I don't even know how much Hong Kong is, but it's like really low. So if China has around 10 and Japan has 17, but China has much more better fundamentals than Japan. If China's fundamentals are substantially better, if their companies are just substantially lower valued, then perhaps if we did see some kind of yuan carry trade, then maybe we can see stocks rise substantially higher than how the Japanese Nikkei performed, for example. That's what I'm wondering. If capital flows and when the yuan carry trade or anything of that sort starts, it kind of snowballs, like where the demand for Chinese assets, Chinese bonds, and then Chinese equities and stocks rise as well. Like it's kind of like a snowball effect. So it starts slow, right? It starts slow and it snowballs upwards as more demand grows, and then it just keeps piling on itself. So maybe we could see that, we could see like a substantial rise, like a even stronger version of the yen carry trade, and it can be because of based on fundamentals more, right? So rather than just arbitrage, it can be based on like Chinese companies just being generally undervalued, right? Cool. I noticed that a lot of Chinese companies too, whether it be NIO or NIO or other things like or ZEP, a lot of these companies were not profitable, but a lot of them, despite with government support as well and domestic consumption increasing, even if their international consumption has gone down, I've noticed that they're starting to hit profitability or they're very close to profitability. So when you see I think the Europeans and Chinese, they're making some kind of big trade agreement, and if we can see the Western markets open up more, then I think their profit margins are going to rise even higher, despite being profitable now or being near profitable. So that's actually it's a very big deal. So if the underlying company's financials can justify profitability and steady profit growth over time, investors might think, well, yeah, like there is that discount because of geopolitical tensions or whatever racial biases, but or whatever, I'm sorry, or whatever. Like you could see that the underlying asset or the company is a very good company, and I think a lot of the guidance or the projected growth may not be factored in, because they're not counting in like an expanding international market again. Because I've noticed that, yeah, the international markets have gone down tremendously for companies that are based in China, but if they can grow under mainly domestic consumption while their international consumption goes down, then yeah, as tariffs are reduced, as trade barriers are reduced, which will happen. Like there's just no ifs and buts about it. It just has to happen. And monetary policies show me that countries are really willing to set that up. Yeah, maybe the profit margins will go up higher over time along with their revenue. So maybe there could be like an upward explosion of these stocks, because a lot of it's undervalued from the company's financials nowadays, like where their PE ratios are just not anywhere near the premiums someone's going to pay for a Western company. So like, do I think Nvidia or Palantir are good deals compared to a lot of Chinese companies nowadays? No. So yeah, fundamentally, these Chinese companies are just better deals. And when the trade barriers are reduced as well, then and more capital flows move into the country, then I expect these companies to and their stock to do much better. Though again, all this is just my opinion. And again, like a lot of us China bulls knew this, but we were just wondering when. And now we're starting to see like social changes where sentiment towards China is going more positive, where the United States is viewed as kind of a loser and where they're not winning wars anymore, or they never were. But to me, none of that really matters too much. I mean, the positive sentiment and Americans accepting that China is going to be a big player in this world is something that matters. Thinking that one country is a loser is not. I don't think any countries are losers, but I just think that, yeah, the positive sentiment towards China and all the soft propaganda has been very, very good. Like when you have IShowSpeed going to China, or if you have Trump saying that he wants Chinese foreign direct investments into the United States and that he wants to build electric vehicles into the United States. So, yeah, you should lower interest rates because if you're also China and you do this huge evil EV war and you want to build your factories in the United States, you may not want to use like Chinese earned money to build investments in the United States. So the United States should lower interest rates, and capital inflows into China should be promoted by the United States, so that the AI bubble can deflate, the United States can become less financially risky and move towards a real economy, but lower its interest rates and lower tariffs so that inflation can go down, because you can export Chinese deflation into the United States along with other countries. And so even if wage growth slows down a little bit, even if interest rates are lowered down heavily, you can reduce inflation and cost of living by buying certain types of bonds like your agencies or your mortgage-backed securities, along with having Chinese foreign direct investments into the United States. But Chinese companies like NIO or BYD shouldn't use their own financing, immediate money and cash savings that they got from like the Abu Dhabi or other countries. They should be able to raise more capital off of Western markets and Western institutions and firms. And you can have all your firms in the United States and governments and pensions to buy into companies like NIO, so their evaluations grow from like 10 billion to, I don't know, 80 billion again. That'd be great for me. Have them go up to like 100 billion and let these companies like NIO raise 2 or 3 billion off the stock market and use that capital from Western investors, primarily Western. Well, it's going to be a mix of everything, but and then use that money to build factories using American supply chains and Chinese supply chains and emerging market supply chains, along with American laborers and American resources. So that de-risks China, because in the end of the day, China doesn't need to come to the United States, because China doesn't really need the Western markets that much. They can expand into the global south more, the global north, or build away from the United States entirely. But the United States and China will benefit from everyone just doing well, because if you don't, then there's nuclear Armageddon. If you do, then people relatively live peacefully. So, yeah, if you lower interest rates in the United States and let Chinese companies appreciate in value, especially the ones that plan to build factories in the United States, then you can raise, then NIO or BYD can raise capital from Western markets and build factories using Western capital. So that reduces the risk for the Chinese company as well if there's ever like a seizure, if they want to take these companies for some odd reason, or if the company in the United States doesn't do so well because politically people don't want to support the Chinese factories or Chinese companies, that, or if there's lobbyists against it in the United States, like something like, I don't know, whatever, it makes it much easier to form for joint ventures or build factories, because it de-risks for NIO, for example. So maybe some parts of the government are opposed to it, maybe some factions within the elite could be opposed to it, but I don't think Trump is opposed to it at all. I think he's very much a globalist when it comes to China. So yeah, that way it really does de-risk the investment for NIO. So yeah, I think that's one way we could see it. And yeah, if there's some kind of yuan carry trade as well, because China just becomes more attractive for investors, then we can see way more capital inflows. And yes, there will be some inflation in China as a result, but that may be good, especially if the yuan strengthens versus the dollar and maybe versus some other currencies as well, so China can start buying up more goods and more resources if global production expands as well. But also, the United States lowering interest rates benefits most of the world because it makes it much easier to borrow. Costs go down, global liquidity goes up. So it makes everything much more affordable, and emerging markets and third world countries and second and first who borrow in assets, or they borrow in ways that are denominated in the dollar, it becomes much cheaper to borrow, so that can boost global productivity, which I think we're going to see very soon. Chinese companies and Chinese electric vehicles and Chinese factories here. And under those conditions, we'll probably see lower rates. It'll probably be very similar to a time where Tesla was expanding into Shanghai, like the feeling where rates were lower, I think. I don't know for sure. And optimism was a little bit higher, and the economy was just running a little bit hotter. I think is something we're going to be seeing, along with like less trade barriers. I mean, I guess you could have some tariffs, but you don't want to have too many tariffs because you do want to import deflation from these countries. It would really help the United States as we lower interest rates. So we'll see how that goes here. I mean, it is kind of scary. Like, it's very eerie, right? When you have like Maduro captured on January 3rd, and then you have Soleimani, you know, I don't know if I can say the word, but gone in 2020 of January 3rd. So yeah, I hope we don't see some sort of black swan event. But even if we did, I don't think that's a bad thing unless it's towards China. But if we see something like we did in 2020, then that was generally positive for globalization and the transition from internal combustion engine to electric vehicle. Let's see, China's growth in home prices. So I don't know how accurate this is, because this is someone else's chart, but this is November 2025. So we sort of see that if year over year China's housing sector enters a prolonged downturn, maybe we could see some positive growth, but I don't know, because it really depends on how you look at it, right? I don't know where the data is gathered from, if it's from like all regions within China, but yeah, you might want certain parts to go down, but you may want some to go down slower, and you may want to promote urbanization as global productivity goes up as well. So let's see, financial industry, professional expect China household savings to continue shifting to equities. So yeah, even the Chinese government, this is from the ChinaDaily.com, they want financial industries as well have been seeing that household savings have been moving into Chinese equities, wealth management, product, gold, insurance in 2026. As persistently low interest rates and rebound capital markets accelerate diversification and household asset allocation. Okay, reforms to reduce China's high household savings. So yeah, you want your people to invest in the markets, and honestly, you want them to do it now. The faster they do it, the faster you'll see the Chinese markets rise as well. Because if you want to boost up the wealth effect for your people, then if they move away from real estate and into the stock market, if more capital flows move in under the United States lowering interest rates and global productivity going up and tariffs going down, and more capital flows into China, or capital outflows move from the United States into the real economy, then you want your people to benefit, so the wealth effect grows up because their production capacity is so high anyway that you can have the profits and revenues grow substantially for these Chinese companies. So if you think the Chinese companies' profits and revenues are high already, then you still have much more demand that's possible from the domestic economy, along with the Western economy, along with global demand growing up in general, which could allow for Higher profit margin opportunities as costs go down. The stronger yuan can make costs of purchasing resources much cheaper as well, along with Western markets opening up and other markets opening up as well, and consumer demand growing as well. So the surplus is there. So the profit margins could grow higher along with the revenues. So let's see. I don't really know why I had this open. I mean, I visited Vietnam. It was very beautiful. So should this matter? Vietnam interest rate. I don't think. Yeah, I would have to look into this. I don't. I wonder if there's something going on here, like in terms of the carry trade or something. I don't know. I have to look into it. Very interesting. I'll look into that later. Bond yields. I think I was just looking up for me at this point. Federal fund rate. What was I looking at this for? Securities, constant maturity. Oh, okay. Fed rate, market yield on treasury. So let's see how the 10-year is doing. Yeah, maybe the 10-year will either go down, or the Chinese 10-year and Chinese government bond yield will go up. Chinese and differential. I was looking at the European FTSE to see how things were going here, and yeah, apparently the CAPE ratios of these are really high as well. So I don't really know, like, even if the United States were to lower interest rates, if like, I still think that China, from an investor's point of view, based on global CAPE ratios, like China is going to just be one of the most attractive investments. I mean, even if you look here, like, yeah, Brazil has relatively low PE ratios compared to the United States. Canada does too. Mexico as well. Some of the Latin America and some places in Europe. But at the same time, do they have the capacity? Do they have the means of production? Do they have the strong economy? Do they have the strong financial markets that the United States has or Japan has? No, they don't. So, you know, when you look at the EU and you look at the United States and all the other world, yeah, like the PE ratio and the CAPE ratios are just so much lower in China, that the companies are just so undervalued and the financial markets are just substantially undervalued, that any kind of risk that people think about is just not. If you're looking for ROIs, if there's no kind of black swan event or any kind of intervention, then capital flows would be promoted into China.